All right, so in today's video, we're gonna get over every single reason why I choose swing trading over day trading, why I found it to be a lot more profitable, and the reasons why you should consider swing trading instead, because it could just be the last missing piece for you to go from that break-even stage to actually becoming a profitable trader. I've seen a lot of traders go from break-even for literally years, 1 to 3 years stuck in that break-even phase. And just them switching over to a higher time frame type of trading to swing trading, they've seen a lot of very good improvements and they've been able to start making profits in the markets. So let's get straight into 5 main reasons, and make sure to stick around until the end of the video because I have one bonus reason that is honestly a super key trick that you guys can start using to make more money trading. So with that being said, let's get into the first one. In swing trading, I found that you have a higher predictability for high risk to reward trades. When we're talking about taking trades that are 1 to 2, 1 to 3 risk to reward, you want them to be predictable. The thing is that with day trading, when I was taking those 1 to 2s and 1 to 3s, they would work out less. What that means is that your win rate is going to go down a lot more when you start looking for 1 to 3s on the 15-minute chart compared to if you look at 1 to 3 risk to reward on the 4-hour chart, for example. This is something that I realized after trying out both of them. Because when I first became a profitable trader, I was day trading, but I was day trading with a 1-to-1 risk to reward. I remember I was day trading mostly high volume pairs like GBP, JPY, and I would look for 1-to-1s. I wouldn't look for 1 to 2s and 1 to 3s. Later down the road, as I started to look for those type of trades, I realized they were not as effective. And obviously risk to reward is one of the most powerful things you can use, because even if you have a 50% win rate, you can still make a lot of money if you have a positive risk to reward. But I found that when I would look for those 1 to 3s on the 15-minute chart, sometimes my win rate would go down to like 30%. And then it's like barely profitable compared to on the swing trading. When you're trading higher time frame market structure, you're going to see that you can still have a 50%, a 60% win rate because you're taking less trades and the market is more precise and more predictable on these higher time frames. It's just something that I've noticed. If you're looking at the higher time frame market structure, it's going to play out a lot more than the smaller time frame market structure. This is something where I can sit here and explain it all day, but I think it's something that you guys need to go out there and test for yourself. The ability to find high risk to rewards consistently will play out more when you're trading the higher time frames. It's that simple. Number 2, swing trading is a lot better for your psychology. So one thing that I noticed is that if I took a loss on the 15-minute chart or the 5-minute chart, that loss would impact me more than if I took a loss on a swing trade. And the reason is simple. Let's say I'm risking $4,000. What's better? To lose $4,000 right away in 5 minutes, or to lose $4,000 over the course of 24 hours? It's obviously going to impact you a lot less if you have 24 hours to handle that loss emotionally and to take that loss. The key part about this, the second part about this, is that it also leads to overtrading. Because if you lost 4K in 5 minutes, your brain just wants to make back that money a lot faster. If you lose it over the course of a day, it's not going to impact you as much because it's over the course of 24 hours. People overlook this all of the time, and some people even say that psychology in swing trading is harder. It's not. For me, actually, patience in swing trading is easier than the patience in scalping. Because when I take a scalp trade or a day trade, I'm watching the market all of the time and I'm waiting for it. I'm just watching. I'm doing nothing else other than just watching the market and waiting for that take profit or that stop loss to get hit. But in swing trading, you can place a trade and walk away. So that's the huge difference. You can take a trade and walk away. This is going to get into another point later in this video where I'm going to be talking about flexibility. The fact of the matter is, you can take a trade, analyze it for 10 minutes in the afternoon, analyze it for 10 minutes at the nighttime, And all in all, you've spent maybe 30 minutes a day on the charts, but you're still making as much money, if not more, with a lot less work and a lot less stress, and your psychology is not going to be impacted as much. Remember, you can risk more because you're not taking a 5-minute trade, which is based on random market movements. Any little news event can stop you out if you're on the 15-minute chart. If you're on the 4-hour chart, now we're talking. Now you have that flexibility, you have that room, and you're in a more predictable market. And this ties in perfectly to the third one, which is long-term scalability. Long-term scalability is something that I care about because I'm in this to go big. I'm not trying to stay stuck trading 5 lots or 10 lots for the rest of my life. I actually want to get to the point where one day I can potentially risk, who knows, 100,000, 200,000, 700,000, or even $1 million on a single trade. That's never going to happen on a 5-minute chart. Think about it for a second. Would someone realistically ever risk $1 million on a 5-minute chart for a trade? That's just not going to happen because there's too much unpredictability on those smaller time frames. Look at this trade right here on USD CHF. I took this trade. It was based on the 2-hour, the 4-hour time frame with my daily bias in mind. So look at here. We had the weekly bearish, daily bearish, 4-hour, 1-hour time frame. We had that time frame analysis, or that time frame alignment, I meant to say. And this was a confident trade. I was able to go to sleep with this trade open because I'm trading with the trend, and it's a trend that's higher time frame based. If I'm on the 5-minute, now all of a sudden any pullback can stop me out. It doesn't even matter if I'm correct on the direction. Any pullback can just stop me out, right? So let's say I'm here, the market pulls back. Let's say I'm using a Fibonacci strategy, and then I enter in right here at the 50% area. I'm going to make this in a different color, right here in pink. So let's say I enter this sell position right here, and I'm targeting a 2-to-1 risk to reward. Boom. As you see, this trade would have gotten stopped out. Even though I'm correct on the direction of the market and the market overall moved down, because it's such a smaller time frame, even though we bounced off the EMA, we had everything in alignment, there's a lot more randomness and a lot of stuff happens on these smaller time frames. I know people like to say that the markets are fractal, and they are to some degree. But when it comes to statistics and actual like predictability of it, it's not the same. So that's one thing that I learned. And this is very important. My long-term scalability is what I want to be doing down 5 years the road, down 10 years down the line. What do I want to be theoretically doing? I want to be able to get to the point where I can risk $1 million on one trade. And think about that for a second, because if you set that bar high up there, it's not just thinking about tomorrow. Okay, well, I would love to get to the point where I can risk 5 to 10K per trade. Sure, that can happen on the day trading side of things. But getting to the hundreds of thousands of risk, you actually think you're going to be able to do that on the 5-minute chart? No trader does that. Even the biggest scalpers in the world are only risking 5K because they understand that there's randomness on those smaller time frames. There's things that they cannot foresee. There is some randomness on the higher time frames, but a lot less, because you're trading where the market is actually going versus a small movement that can be changing all of the time. So there's a key big difference right there. If you told me, okay, you're going to risk $1 million 10 years from now on one trade, how would you do it? I would use my swing trading strategy, and I would trade a trend that is trending on the monthly time frame, the weekly time frame, and I would probably enter in that trade on the daily time frame, daily or 4-hour, because I want more price movement. I want bigger trends, because those bigger trends are harder to stop and they're more likely to keep going. So key difference right there when it comes to scalability and how far you actually want to take this, swing trading is better for that. So number 4, one bad week in day trading can completely mess up your trading results, but one bad week in swing trading can pass by as if it's nothing. So let's say, for example, we're swing trading in the first example. We're risking 3% per trade and we find 2 trades. Let's say this week the market conditions are not that good and we lose both trades because the market just is not respecting trends and it's not respecting bullish market structure or bearish market structure. So we're down 6% this week. This was a bad week. We lost both trades and the market was being very unpredictable this week. Take that and compare it to the second scenario of day trading. A day trader on average will take somewhere between 5 and 10 trades per week. Let's say we take 8 trades and we're risking 2%, less than the first example, on each single trade, right? So we're risking 2% per setup. We lose all 8 because the market just isn't respecting market structure and it's not respecting price action. If that happens, now we're down 16%. We're down massively. And this can happen. If you ask any day trader who has enough experience and is actually telling you the truth about how the market moves, he or she will be able to tell you that an 8 trade losing streak does occur sometimes. It does happen, especially on the day trading side of things. If they say that does not happen, then obviously they're either lying or they have a very low risk to reward and high win rate strategy. If you have an 8 trade losing streak, that can significantly affect your trading. And it means you have to either risk less or be comfortable with being in drawdown 16%. It's a lot more than the swing trading side of things. And I know what you might be thinking. Well, how do you know the swing trader doesn't lose 8 trades in a row as well, but over the course of 4 weeks? The reason why that is, no one understands this, and I've never heard anyone talking about this, is because not every week in the market is the same. Let's say you take the month of February. You take 2 losses on the first week of February because the price action just wasn't there. If you keep doing the same thing, chances are the second week of February is not going to behave as the first week. There's either going to be a bullish trend or a bearish trend, or it's going to be consolidating, but something is different is going to happen. There's different phases inside of a single month. And the fact that you're able to diversify that over the entire month of February means that you're going to have more consistent results compared to that one trader who's taking 8 trades all in 1 week. So if the market has a really bad week where you cannot predict what's happening, where it's just hard to trade, you're gonna lose more if you're day trading because you took more trades. So you can't risk as much. You can just risk more money on swing trades, and the probability of entering a losing streak is a lot lower. Think about this realistically. If you're taking 2 trades per week, the highest quality trade setups you can possibly find, and you're looking at all of these Forex pairs, 20 Forex pairs, compared to day trading where you might only be trading a couple of assets, realistically, are you going to have an 8 trade losing streak? Are you going to lose for 4 weeks in a row? Probably not, because some of those weeks are going to trade differently than other weeks. Day trading, you can have one bad week where you lose the entire week. That can happen. That's the difference. The difference is in that it's unlikely to enter a losing streak with swing trading. I'm going to tell you something. In the past 5 weeks, I've only had 1 losing trade. And on average, I've been taking 1 to 2 trades per week. So I think that's 7 wins and 1 loss. It was a small loss on GBP JPY. So that just goes to show it's a lot less likely to enter these losing streaks. It's a more professional way of trading. It's a lot more professional. I look at day trading as an active income that you have to work for. I look at swing trading as a passive income where it's close to passive. It's not fully passive because you still have to analyze the markets, but it's closer to passive income a lot more than day trading where you have to be on the markets present. Swing trading is more like investing. So those are the 4 big differences. Number 5 is that you have more time to take your entries. Think about making a decision. You know how the saying goes, don't make a decision quickly, sleep on it, and then make the right decision? That's because the more time you have, usually, the smarter and the wiser your decision can be to a certain extent, right? You're not going to sit there and think about it for days, but having that period of at least 1 hour to decide if you're going to take a trade or not can make the difference between regretting the trade and hitting stop loss or being confident in the trade and hitting take profit. I have a perfect example of this. This week on Euro GBP, I thought about selling this market. I was going to sell it right here. So I was going to sell it at the beginning of this week on this pullback because I thought we had pulled back and the market was going to start going down right on this bullish candle right here. But I said this in the chat. I said to my members, hey, look, I'm actually going to wait because I want to wait to see if it is going to reject right off of this zone, 86,440. And guess what? The market did not reject and it continued to go bullish. I gave myself an hour to analyze what was happening before entering. If I wouldn't have given myself that 1 hour, I would have entered this trade and taken a loss. That's because I took extra time to make that decision. And I only had the luxury of waiting for a 1 hour candle because the trade itself is based on the 4-hour time frame. So if you're trading on the 4-hour time frame, you can wait a whole 1 hour candle to then be sure if you want to enter the trade or not. If you're trading on the 15-minute time frame, 5 minutes can pass and then you lost the trade. You missed the trade. You lost the opportunity. So you have to be extremely fast if you're day trading, which is fine, right? No one has a problem with being fast. The problem is that we're not perfect, and if we give ourselves only 2 minutes to analyze a trade, a lot of the times we're going to make the wrong decision, and then we're going to look back and regret that trade. I know that exact feeling because that's happened to me so many times. At the end of the trading session at 2 p.m., I'll look back, I'll write it in my trading journal, and I'll be pissed off that I took a trade because it wasn't the right trade to take. But I took it because I was rushed. I took it because I know if I hesitate, I miss the opportunity. That's a huge thing. The more time you have to make a decision, the better the decision is going to be. I learned this the hard way, and swing trading optimizes for this perfectly. Now for the bonus reason, number 6 is the flexibility. In swing trading, sessions don't matter. It does not matter if I take an entry during New York session, London session, Asian session, or even in the middle of the daytime. It does not matter when I take the entry because chances are my trade is going to pass by all of those sessions anyways. So it does not matter if I enter at a certain time. It also does not matter about momentum or volatility. Therefore, I don't have to trade during a high volume session. Day traders have to be on the computer for at least 2 hours, and they have to be on the computer at a certain time. So if you have a job, if you're traveling to different time zones, or if you just want the flexibility to do what you want when you want to be able to go to the gym in the morning, you can do that with swing trading. You cannot do that with day trading because you're either at the job, so you cannot watch the market, or you're working out, or you have to make sacrifices to your own personal schedule to then be on the markets at that certain time. And that, unfortunately, for a lot of traders, makes them think that trading is not for them because they have a full-time job and they cannot watch the markets. Swing trading, you can check the markets 15 minutes in the morning, 15 minutes in the afternoon, and 15 minutes at night. That's what I do. Sometimes a little bit more than that, but I check it when I want. I take trades during any session. Flexibility is huge, and it's a huge advantage for swing trading. So I hope this video helped clear up why I will choose swing trading over day trading, why I choose it, why it's better, and why objectively I think this is more suited for profitability, especially in the Forex markets. I think if you're talking about futures, things can change. I think especially in these Forex markets, I think swing trading is by far the most profitable way to trade them, and it took me years to learn this. So let me know in the comments below if you want to see any future ideas and for a future video and consider it for my next video. So I will see you in the next one, and I appreciate you for watching this.